Hi, DataTrek co-founder Jessica Rabe here, and today's video is on the current state of the U.S. labor market, a critical driver of future Federal Reserve monetary policy, domestic economic growth, and corporate profits. The strength of the American labor market has been a consistent tell in terms of the Fed's rate decisions throughout its entire latest tightening cycle, and it continues to shrug off high interest rates even now. That's important because it is hard to see inflation getting back to the Fed's 2% target with demand for labor still so strong. The FOMC knows this all too well, which is why so many Fed speakers talk about interest rates remaining higher for longer. Now, while we look at traditional labor market data sets, we also regularly review both unconventional and more detailed metrics because many are real-time indicators that explain what's driving the headline jobs numbers. With that, I'm going to briefly go over a few charts that capture the current state of the U.S. labor market. Let's start by looking at 3 charts from Google Trends that address the labor market strength and ongoing pandemic-era trends, like work from home, wage pressures, and excessive quits rates. Google Trends simply counts how many times users query specific search terms. By looking at the time series of this data, we can evaluate whether their popularity is rising, falling, or staying constant. We know many people question the accuracy of the official jobs data, and that's entirely valid, an entirely valid concern. Google Trends is a great reality check, which is why we use the tool so much in our work at DataTrek. So first, here's a chart that shows US Google search volumes for Ask for a Raise over the last 5 years, and another chart that shows the year-over-year change in average hourly earnings. US Google searches for Ask for a Raise peaked in June 2022, shortly after average hourly earnings hit a post-pandemic high in March 2022, up 5.9% year over year. As American workers have lost confidence in their ability to demand higher pay, with Google searches down 7% in 2023 year to date versus 2022, average hourly earnings have also fallen steadily, now up 4.1% year over year in October. However, search interest in Ask for a Raise is still up 36% versus pre-pandemic 2019, and as a result, average hourly earnings growth still exceeds pre-pandemic levels of just 3.3% annual growth in 2019. The good news is that both metrics are coming down from last year's structurally high levels, but the Fed will want to keep cooling the U.S. economy with higher for longer interest rates. That message is meant to put pressure on the U.S. economy and diminish workers' confidence that they can negotiate higher wages. Second, here are U.S. Google search volumes for remote work over the last 5 years. There's also a chart that shows U.S. office occupancy back to 2020 with the data from Castle Systems, a leading provider of office security hardware and software. Searches for remote work remain at structurally high levels and just hit a 5-year high 3 months ago. Americans continue to feel secure enough in their current or future employment to push for at least some remote work. This is also reflected by still low U.S. office occupancy, which remains at just 50% even almost 4 years after lockdowns. To put this in perspective, office occupancy was above 95% before Q1 2020's lockdowns. Now, even the Fed's latest Beige Book mentioned that businesses are partly mitigating higher labor costs by allowing remote work in lieu of higher pay. As much as wage growth continues to fall, the real tell about the trajectory of the U.S. economy likely lies in American workers' return to office. If a recession is truly close, we should see office occupancy turn meaningfully higher as employees trade remote work for job security. But as the latest Castle System data shows, we're simply not there yet. Next, our last Google Trends chart shows U.S. Google search volumes for Leave Job over the last 5 years. I also put up a chart of our Take This Job and Shove It indicator, which is the ratio of quits to total separations from the monthly JOLTS report. It came in at 66% in September 2023, the latest available data, which is still well above pre-pandemic levels. For example, it was 60.4% in February 2020. Both these charts show American workers are still too confident in the U.S. economy and their ability to find better job opportunities than the Fed would like to see after their recent very aggressive rate hikes. Now, here's why that's a problem. Here's a chart that shows the 3-month moving average of median wage growth overall, as well as for job switchers and job stayers. Job growth for job switchers was up 5.6% year over year in October. That's down from the record high of 8.5% in July 2022, but still far higher than growth of 4.5% in February 2020. Wage growth for job switchers is therefore skewing overall wage growth higher, which is currently up 5.2% year over year. Meanwhile, wage growth for job stayers was up 4.8% in October, still much higher than 3.2% in February 2020, but at least somewhat of a drag on overall wage growth. So the bottom line here is that wage growth for job switchers and job stayers still far exceeds pre-pandemic levels. Yes, they are at least falling relatively quickly, but it's important that this downward momentum continues. The late 1990s and early 2000s experience shows wage growth could remain elevated above 5% for job switchers and 4% for job stayers for years. This sort of growth is possible now, given that there are still 1.5 times the number of job openings as there are unemployed workers, whereas there were more unemployed workers than job openings in the early 2000s. In Chair Powell's last FOMC press conference, he said that he sees a historically large difference between openings and unemployed workers as potentially playing an even larger role when it comes to possibly pressuring wages and therefore overall inflation going forward. So overall, our 3 Google Trends charts and supplemental job and wage growth data show the Fed's aggressive tightening cycle has had little impact on American workers' psychology in terms of how they navigate the U.S. labor market. To finish up today's video, let's take a quick look at Thursday's U.S. initial and continuing claims for unemployment insurance because they took an unexpected turn lower after trending higher in recent weeks. First, here's a chart that shows weekly initial claims from the start of 2022 to today. After 3 weeks of average or slightly above average readings, the most recent result of 209,000 this past Thursday fell back below the 2022 to present mean of 220,000. This year's peak claims were in June at between 262 to 265,000 a week, so Thursday's reading was 21% below those highs. In addition to the lower than expected initial claims number, continuing claims declined sequentially, the first time since September. Since September, ongoing claims have been rising and even surpassed the April 2023 highs 2 weeks ago. This past week, they fell by 22,000 to 1.8 million, and that cannot be explained by seasonal adjustment factors. For example, there's a year-over-year percentage increase in continuing claims dropped to 23% last week from its band of 24 to 30% since May 2023. The bottom line here is that while demand for labor looked like it was starting to finally roll over for a few weeks recently, this past week showed the U.S. labor market remains quite resilient. With much of the current rally predicated on lower policy rates next year, the continued robust labor market shows this assumption is far from a lock. We're still bullish on U.S. equities the rest of this year, but we'll continue to review both traditional and non-traditional labor market data sets in conjunction with Fed funds futures and Treasury yields and our DataTrek morning briefings to stay on top of these trends and make sure our readers remain ahead of the curve. So that's our current take on the U.S. labor market. There's been some weakening, but both the official data and Google Trends search volumes show it remains surprisingly strong. On the plus side, that means corporate profits should have a nice tailwind in both Q4 and Q1. On the downside, markets may have to reassess their assumption that rate cuts are just a few months away. As always, please like and subscribe if you found this information useful, and be sure to check out our website, datatrekresearch.com, for a free trial to our daily reports. There's no credit card or personal information required. You just have to drop an email in. Thanks again for watching, and we hope you have a great day.